So you have been waiting on the sidelines or are still unsure about the market going up even though there's plenty of evidence that we are in a raging bull market at a global scale. In this video, let's look at why this bull market might still be in its early stages and why there's plenty of opportunity for you to build wealth and get rich over the next few years. Building wealth is subjective, and generally speaking, all I want for myself and for you is to incrementally do better money-wise over the long run. For the sake of this video, we are going to focus a lot on the US market as it's over half of the global stock market, and as it grows, so do the other markets. Nothing in this video is financial advice, and think of it as just my opinion. Let's begin. The stock market has been on an incredible run since bottoming in late 2022. Despite uncertain economic times, geopolitical risks, and no shortage of worry, stocks have been steadily climbing a wall of worry to reach a new all-time high in 2024. If you have had the conviction to stay invested over the last 18 months, your portfolio has done incredibly well. Most likely, just like my portfolio, your portfolio is also sitting at all-time highs. Many investors are still sitting on the sidelines, skeptical if this is a real bull market or not. They point to high valuations, the potential of the Fed to over-tighten, and the risk of a recession as reasons to doubt the rally. However, history shows that bull markets typically climb a wall of worry, with stocks rising despite widespread pessimism and doubts. In fact, the S&P 500 has already gained over 40% from its October 2022 low. This basically means that it has moved far past the start of a bull market. While 40% is impressive gains, the reality is that this bull market is still likely to be very young with a lot of room to grow. In fact, the average bull market since 1932 has returned over 150% and lasted over 5 years. The 4 bull markets since 1990 have at least doubled before eventually peaking. So while it may seem very uncomfortable to be investing into stocks at an all-time high, that's the very nature of a bull market. Stocks will continue to climb a wall of worry, unlocking potential opportunities for those who can look past the noise. If you feel like you have been underinvested, it's still not too late to participate. As stated earlier, this bull market has a long way to go. Now let's look at some of the key drivers of this bull market, and then we'll share some tips on how to profitably navigate it. So I want to talk about the combination of 5 factors that I believe are driving the market, starting with something that I find really interesting, that is the 18.6-year real estate cycle. I was first introduced to this concept by analyst and YouTuber Jason Pizzino. He's got some great content and I highly recommend that you check it out. So the 18.6-year real estate cycle, as identified by economist Phil Anderson, is a major factor propelling this bull market. The cycle, which has been traced back hundreds of years, is currently in its melt-up phase. In this phase, which typically occurs in the last 3 to 4 years of this cycle, asset prices rise rapidly as speculation and optimism reach new heights. Real estate prices lead the charge, but the euphoria spills over into the stock market as well as other assets. One thing to note is that the real estate cycle bottomed in 2009 after the great financial crisis. This kicked off the new 18.6-year cycle. Counting 14 years up from there lands us right in the heart of the melt-up in 2023-2024. This is no coincidence, and the rhythm of the 18.6-year real estate cycle may be playing out yet again. As occurred in prior cycles, there are signals that the bull market in stocks has more room to run. The next thing that we want to look at is a resilient economy and corporate earnings. Despite worries about inflation and interest rates, the US economy has been surprisingly resilient. This is providing fundamental support for the bull market. GDP growth and corporate earnings have been stronger than expected. The S&P 500 earnings rose 5% in Q1 2024. This is the fastest growth in 2 years and is set to hit record highs in the remaining of the year. Historically strong profit gains means that the stock market is going up even further. The robust labor market and still healthy consumer spending are underpinning economic momentum. And now with inflation cooling, the Fed may have room to pause or even cut interest rates in late 2024, which would provide a major positive catalyst. The next reason is broadening market leadership. What this means is that the bull market of 2024 as compared to 2023 is driven by a broader group of stocks. In 2023, the gains were highly concentrated in the Mag 7. As the megacap tech trade has slowed down, leadership has rotated to other areas like financials, industrials, energy, healthcare, and smaller cap stocks. A wider set of sectors participating in the rally means that it's going to be a more reliable, durable, and stronger bull market. The next reason is investor sentiment and fund flows. The investor sentiment, while it has improved from last year's pessimism, is still far from the euphoria typically seen at major bull market tops. Many investors remain skeptical of the rally and are not fully invested. As more and more of these investors enter the market, we are going to continue climbing the wall of worry. Institutional investors like hedge funds have started putting more money to work. However, their equity exposure is still below historical historical averages. As they capitulate and invest further, the markets could go up higher. One thing to note is that there are several other signs of a bull market, such as the approval of the first spot Bitcoin ETF is bringing significant inflows into crypto assets as well. This kind of speculative investing is also a sign of the melt-up psychology. Overall, just watch the general trend of the market and you'll see that we are in a bull market. The last factor that I want to talk about is favorable seasonal and election cycle factors. Stocks have a strong tendency to rise in years when an incumbent US president is up for re-election, as is the case in 2024. Yes, I'm talking about Joe Biden versus Donald Trump, but keeping politics aside, let's look at what can happen in the markets. Generally, the incumbent administration often pursues market-friendly policies to boost the economy and stock prices ahead of the election. Even if you do a little bit of research and look at some of the numbers, you'll find a lot of information backing this claim. Additionally, after a stellar first quarter, we are entering even better seasonal periods. While sell-in may go away is a well-known adage, stocks have historically posted solid gains from June through November in midterm election years. So as we see, there's a confluence of several factors that's coming together this year to push the bull market even further. I believe that investors who understand this and align with these forces are going to see outsized returns compared to others. Now let's look at some key tips that can help you capitalize on the bull market and grow your portfolio and wealth. The first one is invest, stay invested, and think long term. One of the biggest mistakes that investors make during a bull market is jumping in and out of different assets due to short-term price movement. The lack of patience can lead to you missing out on some of the best days for your holdings. Most likely the only thing you'll achieve from jumping in and out is reduce your overall returns. Instead, adopt a long-term perspective and stay invested throughout the bull market. Historically, bull markets have lasted 5 to 6 years on average. If you invest consistently and hold quality assets, the rising tide should lift your portfolio over time. Don't get distracted by the temporary pullbacks and the short-term volatility. Stay focused on the bigger picture. The next one is to take advantage of dips to add to your positions. Yes, I know it's very hard to time the market, but if you have been waiting on the sidelines or looking for good opportunities to buy, 10 to 15% is maybe the max drawdown you'll get during this bull market. Again, while you shouldn't try to time the markets, bull markets do give you opportunities to buy on short-term dips. Instead of panicking during these times, you should take the opportunity to add to positions of your highest conviction stocks. You should keep some cash and some of your profits on the sidelines waiting for the right opportunities. At any given time during this bull market, I have at least 15% sitting in cash. But don't wait for the perfect bottom. Start nibbling as stocks decline and add further if they fall further. The next one is that you should have a focus on quality and not fads. Bull markets also tend to push low quality and speculative stocks higher as investors chase faster returns. But the thing to note is that these stocks also fall the hardest when things get rough. Avoid getting sucked into hype and speculation around meme stocks, penny stocks, and unproven companies. And if you're somebody who's buying into crypto, make sure you take even more precaution. There's nothing wrong in investing in things that are hyped up, just know that they come with extremely high risk. Feel free to speculate with a small percentage of your portfolio, but overall, concentrate your portfolio on high quality companies with strong fundamentals, competitive advantages, and long growth runways. Prioritize factors like profitability, cash flow generation, low debt levels, and capable management teams. These kind of investments grow your portfolio steadily and hold up much better in case you get caught up in a market downturn. Talking about good companies, the next step is to let your winners run. One of the hardest things to do is to hold on to a good investment as it keeps rising, bringing you outsized returns. The temptation to take profits can be very strong after a stock has run 50, 100, 200%. But selling prematurely can cause you to miss out on truly big gains as exceptional companies keep compounding over the years. I can speak from experience because I liquidated my Nvidia position a bit too early. Now, I don't want to downplay the importance of locking in profits either. The best way to handle this is to keep a plan ready to go. If you don't want to take sudden decisions, try to have your buy and sell orders ready to go even before you reach those points. The next step is to diversify but not over diversify. Proper diversification is essential to managing risk in a bull market. Ensure that you are allocated across some sectors and asset classes, but don't concentrate too heavily in one area no matter how hot it seems. Strive for a balance between offense and defense in your portfolio. At the same time, you shouldn't try to hold too many small positions in many different stocks either. What over diversification does is that it dilutes the returns on your winners. Build a concentrated portfolio of your best ideas but diversify enough to mitigate risk against any single holding. This brings us to the next tip, that is rebalance regularly. Bull markets have a tendency to knock your asset allocation out of whack pretty often. For example, a portfolio starts at 80% stocks, 10% bonds, and 10% Bitcoin. Now this could drift to 75% stocks, 5% bond, and 20% Bitcoin if left unchecked. An overly aggressive allocation will leave you vulnerable when the bull market comes to an end, and yes, it will eventually end. Regularly try to rebalance your portfolio into the allocated weights that you had decided. To put it simply, don't forget to take profits along the way in this bull market. The next thing that I want to talk about is controlling your emotions. Bull markets have a very different way of playing with investor emotions. It is easy to get carried away by greed and FOMO as stocks keep hitting new highs, but it can also lead to you taking excessive risk and making stupid decisions. On the flip side, bull markets can also see some scary downturns. Investors who panic sell or sell to buy back even lower often end up regretting their decision. This is because assets tend to rise sharply and very quickly after these downturns in a bull market. Basically, the key is to stay disciplined and control your emotions whether the market moves up or down. We have spoken a lot about downturns, which brings us to the last important tip, that is to keep some dry powder. Bull markets have a way of making us feel invincible, but they don't last forever. Does anyone remember the bull market of 2021 and how we felt we were all geniuses? But what came after that was the reality check. It's hard to predict when exactly the bull market will end, but it will end eventually. Once it ends, the average bear market has historically chopped 33% of the S&P 500. To prepare for this, keep a portion of your portfolio in cash and bonds. This dry powder serves two purposes. It reduces your overall volatility and gives you firepower to buy stocks at much lower prices when the bear market returns. What you don't want is to be fully invested at the peak, and when the downturn comes, your net worth gets cut in half. My plan is rather simple. As this bull market progresses and we arrive 2025 or even 2026, I'm going to move about 30 to 50% of my net worth into cash and bonds. The goal will be to stay prepared for a bear market. Of course, this plan can change if fundamentally something changes as well. Those were some of the major things that I wanted to cover in today's video. Investing in a raging bull market can be very exciting, but it's important to not get carried away. By staying invested, focusing on quality, diversifying intelligently, rebalancing regularly, and controlling your emotions, you can participate in the bull's gains while mitigating downside risk. Approach the bull market with humility and discipline, and you can come out on top with your net worth much higher than where it is today. Always remember that the number one rule of investing is to not lose money, and the second rule is to be richer than you are today. As long as you're tracking the market and following some of the tips that we discussed today, you should be fine. That's it for today. I'll be back next week with a new video. Till then, keep learning and stay on top of your finances. Until next time.